Good evening. We learned from David. Okay. I have to admit that I was quite apprehensive about doing the talk this evening. In fact, I told Punya, maybe you guys called the wrong guy. Because I have to admit, I'm not a very sophisticated investor. I am a banker. Commercial bankers are not necessarily good professional investors. Maybe we should get somebody from the asset management industry. But then I realized the reason all of you are here is for that mini iPad or something. So that puts me at ease. I can say whatever I want. When I say I'm not a very sophisticated investor, part of this too. My personal investment portfolio tends to be conservative, and that is for a couple of reasons. The first of the reasons is the bulk of my savings and investment is in one stock, and that happens to be the company I work in. My compensation is linked to that, and I'm not allowed to take my compensation away for many, many years because MAS makes sure that that doesn't happen. So it stays in DBS stock. And as a consequence, I'm very heavily weighted in equity because of that one stock. And therefore, I try to make sure the rest of my investments reflect that heavy equity concentration. The second reason for that, well, that's true for most people in my profession, is we tend to be very easily conflicted. And I will talk a little bit about that. And that's just because we deal with so many companies in the region, certainly in Singapore. I always know something about the company which is based on a little bit more than public knowledge. And therefore, that precludes me from making investments just because I can never say with sanctity that I'm operating purely on public knowledge. I always have some kind of insider information, if you will. And therefore, the easiest way to stay clean of that is not to make any investments which somebody could raise an eyebrow about sometime in the future. So a couple of reasons for that. Nevertheless, over the years, and I've been in the industry for a long period of time, I've developed some investment thoughts, investment philosophies, which are, like I said, not very complex, and I'm going to share those with you this evening. But let me start first with some of the learnings I got very early in my career. As you heard, I started working at the age of 22, not dissimilar to many of you. I came from a middle class family. My parents weren't very rich, and therefore when I first started working, this thing was getting really good income. I joined Citibank, which was a great paymaster in those days. And so getting a great income was just fantastic. You suddenly felt very rich, you were making a lot of money. 3-4 years out, I suddenly took stock one day and realized that despite the fact that I was doing well, I was getting promoted faster than my peers. But at the end of 3-4 years, I realized I was certainly not the wealthiest among my cohort. And in fact, most of my cohort were already much wealthier than I was at the end of 4 years. And when I took stock, I realized that I had spent all my time working very hard. And so I had no time to really think about putting money to work or investing my money. And so I used to get my income and most of it lay in the bank and went into a savings account or something. There were some of my colleagues in my cohort who actually spent those 3-4 years thinking and worrying about putting the money to work. And at the end of even the first 3-4 years of my working career, I realized the difference between income and wealth. I had a good income stream, which I was not converting to wealth. There were colleagues of mine who took that income stream and they were able to convert it to wealth. Warren Buffett, who is obviously one of the big gurus of investing, said that well. And he said in the long term, the difference, people get rich not from the income they make, they get rich from the savings they make and the investments they do. And that is true. If you just think about it and say, who are the richest people in the world by and large? The richest people in the world tend to be the ones who put capital to work. And putting capital to work, if you think about the returns on labor, returns on capital always tend to be disproportionate. So the theory is quite simple. If you can intelligently put money to work, in the long term, you will wind up being a lot more wealthy than just working hard and getting a positive income. So that was the first lesson I took away at the end of my 3 or 4 years. That it's all very well to have income, and don't get me wrong, it's good to have good income because that's helpful. But in the long term, wealth creation and wealth accumulation comes from smart investing, from putting that capital and money to work. The second lesson I learned took me several years after that, maybe the next 7-10 years. So once I got this wisdom that hey, I need to put money to work, so I said, need to start investing. The first investment I made, I still remember very vividly. So the Indian budget was based in India, and the budget session was due the next day or the day after. And I heard, very reliable source, that one of the things they're going to do is change the iron and steel policy. And so the reliable source friend of mine said, steel prices are going to go through the roof, you better go buy steel stock. So I went and bought the stock of this company called Mukund Iron and Steel. First, I put a substantial amount of income, put it into one stock. I said, hey, budget change and so on. But sure enough, budget day came and they made a change in the iron and steel policy. That was good news. Bad news was that the change they made only benefited some companies and disadvantaged others. To my chagrin, Mukund Iron and Steel was in the category we got disadvantaged and not the category of advantage. So overnight, my investment fell to half. So then I said, fallen to half, this cannot be, so it's got to bounce back. So maybe I should just put some more money instead of whatever else I had to put that into Mukund Iron and Steel. In 1 week, the investment went to a quarter. So by the time I got out, all my 3 years of savings had gone down the tube. So I'm going to come back. So see, I learned an important lesson from that. Several years later, not immediately, but several years later, when the internet boom was being to happen, mid-90s, I got into this thing, everybody is doing day trading. So you could then open an online trading account, I opened one with E-Trade, and then like everybody else, here's CNBC, and you could buy anything and it will go up. So you look at here in the news buy, and then you trade a momentum. So I started doing night trading. Between, I guess, 9 and 11, that's based in Indonesia those days. As we sitting, had the TV on, I used to go and buy some stock, and like by morning I made $5,000, right? And so this was just fantastic, momentum trading. And it lasted very good, lasted all of several months. Till suddenly one fine day NASDAQ tanked. And when NASDAQ tanked, the turnaround was so swift and so rapid that again, half of my investing in this thing got wiped out in a week. And so I learned 2 big lessons with that thing. First lesson is that a lot of people, these are accepted investment strategies. The first strategy, which is around the budget knowledge I thought I had, is information arbitrage. So a lot of people do make good, sound investing decisions because they have information that other people don't. Information arbitrage can be an acceptable investment strategy. The reality is it is not very easy to get genuine, good information arbitrage. And in today's day and age, with internet and social media, etc., it's very hard to find that extra discriminatory piece of information, other than what I said I can't do, other than sometimes to insider trading. So if you wind up with a piece of information which gives you an advantageous position, frankly, you've got to wonder about, hey, am I supposed to have this piece of information? And is it legitimate for me to trade on this piece of information because this could constitute insider trading? The second, so that was one learning. The second learning was a lot of people, in fact many people, some of the best people, investors in the world, do what I did in my internet trading days, which is basically trading on technicals or momentum. Right? So you essentially chart, you can figure out, and the underlying premise of that is actually quite sound, because the premise of that is demand and supply. And any of you who've done economics know that there's a lot of demand, demand's greater than supply, prices will go up. So that's quite straightforward. If more people want the stock than people who are willing to sell, the price of the stock will go up. And so there's nothing wrong with that as a fundamental trading strategy. You figure out based on charts, based on momentum, based on just whatever, that a lot of people want something. And if you can get ahead of the game, you will benefit. The problem with that is that it is not always easy to be able to do this technical analysis, momentum trading, and finally, this is based on sentiment and psychology. And things based on sentiment and psychology are very difficult, it's very difficult to get your hands on. Benjamin Graham, who actually is the original guru, so who was Warren Buffett's guru on trading, he said it well, and he said the difference between speculation and investment is really that. When you're doing a lot of stuff which is based on momentum, based on technical, based on demand supply, that's really speculation. If you really want to think about investing, then you have to go back to value and fundamentals. What is value? What is fundamentals? In fact, one of his most famous quotations, which people still cite, is in the short term, the stock market is like a voting machine. In the long term, the stock market is like a weighing machine. So in the short term, voting machine means it goes by popularity, by votes, by sentiment. The more people who go in for something, the more the stock market will go up. But if you want to take a long-term view, then you have to think of a weighing machine which is based more on fundamentals and values. So early in my life, I learned these lessons that, trading on information, trading on momentum, trading on technicals, these are viable trading strategies, but these are not necessarily good trading strategy for somebody who wants to think about long-term investment and trading on fundamentals. So over the years, I then evolved this, way of thinking around, how to do investments. And I really have 6 things I think about when I do that. Some of these, by the way, get reflected not only in my own personal investments and investing style, but they get invested in how I try to run DBS and how we manage the bank. So in fact, the similarities are great because they reflect how I think about, the future in general. And so as I talk to you about these, I will give you parallels from how I think about the bank and how the bank manages itself and therefore its positions, equally as how I manage my own personal investing profile. So the first is this, that I really think that is really important when you're thinking about investing to focus on fundamentals, and at least a few fundamentals. You can't focus on all the fundamentals in the world, but you need to be able to focus on a few fundamentals. In the context of the bank, when we devised the strategy for DBS several years ago, we focused on what we thought were the mega trends which would impact our region. These aren't all the mega trends in the world, but we identified 4 or 5. So mega trend number 1 is we said, this is a part of the world which is going to grow because of massive consumption demand. The Chinese population, India, Indonesia, large middle class, large consuming population, growing affluence, growing wealth. This has to be a driver. It has to be a driver for the next 10, 15 years. So we said, okay, check one. That's one fundamental that we should remember. Second fundamental mega trend we thought about is, there's going to be a tremendous amount of urbanization and infrastructure spend in our region. And that has to be. There is, again, Asia is urbanizing from maybe 1/3 urban to 50% urban, and infrastructure is very backward. So we reflected and said, what happened in Europe post-Second World War with the Marshall Plan, that's very likely to happen in Asia over the next 10, 20 years. Big infrastructure, big urbanization. So second fundamental. Third fundamental we thought about was this whole thing with Asia is really coming together. The data shows it. Trade, capital flows, north to south, China into Indonesia, into India. So Asia is coalescing. But that means some pretty important things for Asian companies. Asian corporations, Asian individuals, capital flows, trade flows. So we said, okay, that's the third fundamental. And a bit about technology. Now, like I said, these are not all the fundamentals and not all the mega trends in the world. Any smart apologist will tell you 10 are right. But to me, you need to think about a few which you can anchor your investments on. We chose to anchor DBS's investments on some choices we made with respect to that. I think equally, as you think about personal investment choices and decisions, you've got to be able to reflect on some fundamentals about what is happening. And I think that's not difficult to do because the reality is that each one of you recognizes and sees those fundamentals in your daily life. These are things, if you go out into the world, you can figure out what's happening. How are people behaving? How are people buying? What goods are people looking for? What brands are doing well? What do you see reducing in volume? What do you see increasing in volume? From your day-to-day life and from your day-to-day interaction, you will start picking up, hey, this looks like it's a trend. China, India, the same fundamentals that drive DBS's thinking, drive my own personal view for my own personal property or my personal investment. It seems to me that given what is happening in the world, the shift of economic gravity from the west to the east is actually quite profound. And therefore, if you have a long-term view, it seems to me that the growth of China, India, Indonesia, the large consumer middle classes in Asia will drive value creation. And therefore, if you're invested long in some of the industries that benefit from these growth, you will be okay in the long run. So that's a way of thinking about a fundamental thing that is happening. The second fundamental It seems to me that the world is going to be very resource constrained. So the resource constraint will come not only from agriculture, so soft, but it will come from fundamental things like water. There's going to be a massive crunch on water. There's going to be a massive crunch on soft commodities. There's going to be a massive, and you have to think out 10, 15 years when you think about that fundamentally. And step back and say, what does that mean? I think that in time, industries and businesses which reflect that, water resources, agriculture resources, metal resources, I think they will do well. Again, I'm going to come back to timing and cycles. But you've got to go back and think about what is making an impact and what is likely to make an impact at a fundamental level. Perhaps the most profound thing that all of us see is the change in the way we live our lives because of technology. The change in technology and what you do when you stop buying CDs and start going to iTunes, what you do when you start using Uber instead of going into taxi cab, what you do every time you go to Airbnb instead of going and booking a hotel. These are things you see in your daily life. And many of you see them a lot more than I do because you're a lot more plugged into the world of technology. Every time you do something of the sort, you've got to sit back and say, hey, who's going to benefit from this and who's going to lose? If it turns out that a large number of people are going to stop or reduce buying cars because you're going to find a sharing economy around Uber, surely that says something in the long term for who's going to benefit from that trend and who's going to suffer from that trend. So a reflection of macro fundamentals and macro trends is perhaps the single most important thing to think about when you're going to place some bets on where you're going to go. The second, so first principle, think fundamental. Think fundamental, think megatrends. And we can think fundamental, and by the way, I should have started with this and I'll say it now. There's one caveat I wanted to say before I started. You have to, my investment thesis is based on one premise, and that is that you can really have the capacity to invest long term. I'm going to come back to that because if you don't have the capacity to invest long term, and you need the liquidity short term unexpectedly, you need to keep some liquid, then your investment strategies can be quite different. Because then you have to be bothered about short term cycle with short term liquidity. So my comments are really predicated on the view that you have a long term view and you're really thinking long term, you have the capacity to take at least some of your money and let it work for you in the long term. So that's number one. The second thing for me, so now I've got some idea, I've got some view on the mega trend, we've got some view on the fundamentals. Within that, I believe that you have to place some sizable bets. Now this is, by the way, very controversial thinking. A lot of people will tell you that the best way to invest is to run a completely diversified portfolio. So if you run a diversified portfolio, you run a relatively less risky portfolio. Again, Warren Buffett actually said something quite interesting. He said the only people who run a widely diversified portfolio are the people who don't know what they're doing. Think about that. So you can run there's nothing wrong with that. You could run a widely diversified portfolio. You could mimic the stock index of the US, or you can mimic all the stock indexes of the world. I think it's not a bad thing because as Aurobindo told you, over the long term, I think your returns will be better than the returns you'll get in a fixed income or a bank portfolio. However, I still think that's a lazy way to invest. In the context of DBS, I could say, hey, we think all of these are opportunities, let's put our capital to work in all of them. So I'll do a little bit of this, I'll do a little bit of China, I'll do a little bit of India, I'll do a little bit of corporate, I'll do a little bit of wealth, and we could spread ourselves thin. I really think that the trick to figuring out and really winning well is to make some reasoned bets on a few big things. Don't make it one because then you're totally concentrated. But to just scatter and be totally diverse, I think that's lazy. And therefore, to make some choices to figure out of this mega trend, these are the 4 or 5 that I think I'm going to place my bets on, is not a bad thing. If you look back and say who are the really wealthy people in the world, whether it's Bill Gates or Li Ka-shing or Philippung in Singapore, all of them have made money by being concentrated in certain exposures. And therefore, concentrations are not necessarily a bad thing. You have to be able to build sizable positions in certain things. And as long as you choose half a dozen, 7, 8, 10, it's probably fine. You want to try, so widely diversified is a nice thing in theory, but it doesn't make you that incremental thing that you want. In the context of DBS, we chose 3 or 4 big ideas. We said, let's try and build out a large corporate business on cash management and trade finance. Let's build out a meaningful wealth management business. Let's build out a large fixed income debt capital market business because that's where the world is going. So we chose some areas to place our bets on. Those have proven to be successful because we were able to allocate capital, we were able to allocate some management thinking, we were able to allocate some bandwidth to those. I find the same thing applies to my personal investing portfolio as well. So while I have a lot of ideas, I don't have the bandwidth to think about everything. I chose 3 or 4 and said, I'm going to try and make sure I allocate some pots of money to these because I think these are good bets to make. So I went long China through a portfolio fund because I figured China has got to be a long-term story. If I can ride through the cycles, I'll probably do okay. I went long India for that same reason. I went long biotech. I went long biotech because I view that given the changes in the biotech world, there's a high likelihood, and healthcare in general, there's a high likelihood you should be able to do well. I went long education in Asia because it seemed to me that the mega trend on education big. So I chose 4 or 5 big themes and decided to go long. I went to the funds because I don't buy individual stocks, I already explained, and I just left it there. So they go up, they go down. I'm pretty confident that long term, making a few bets in some sectors which align to the fundamentals is probably a good way to think, and it should give me some upside. The third thing around it. So while you want to make these bets and you want to go in for large things, you cannot be blind to the fact that life has cycles, and therefore tactical and timing cannot be entirely ignored. You have to know. So the simplest analogy I draw is when you're driving a car. If you're going on a long distance journey and you're going to drive from here to Kuala Lumpur, it's a 3-hour drive, 3.5-hour drive. It's not like you put it on cruise control, hold the wheel and go one speed 80 kilometers an hour for 3.5 hours. Life doesn't work like that. So you'll have turns, you'll have traffic jams, you got to know when to slow down, you got to know when to apply the brake, you got to know when to press the accelerator. This notion of how do you drive long term, because you've got to be able to pace yourself. That's an important notion in both investing for the bank and investing for my personal portfolio. In the context of DBS, one of the things that was quite clear to us, we wanted to build out an SME business, small and medium enterprise business. Unfortunately, the last 2-3 years, the markets have not been kind. GDPs have been coming off, and when GDPs come off, the SME portfolios tend to suffer. And even though we therefore had a big ambition to grow the SME book, we decided to pace it down. And we slowed down. We still grow it, but not as much as we wanted to, because it would just be the wrong time to try and build out a large SME portfolio and SME exposure. We took a view also some years ago, to be consistent, that the world would be much slower than people thought it would be. We had a view on the US markets and the Asian markets that there would be secular slow growth. And the secular slow growth, then the likelihood is that interest rates are likely to be low for long periods of time. And if that is the case, we did 2 things. One, we built up our fixed income portfolios, and B, we built up the duration of our fixed income portfolios. So the way debt markets work, if rates rise, then if you have long bonds, you tend to get hurt. But if you have a view that rates are going to stay low, then you can go long bonds and pick up the extra spread, extra yield. So we took a decision based on tactical timing and based on a tactical cyclical view that this is a good fund to do. So we will go long, we'll hold bonds, and we'll ride through the low interest rate market. Now, again, I do that in my personal portfolio as well. And so the one area where I did go quite long, 3-4 years ago, and I still have a large part of my personal investment in, is actually bond portfolios. Typically, most data would tell you that equities and equity investments outperform bonds in the long term, but it depends on the windows you look at. And certainly, if you look at the window over the last few years, I have been very satisfied with the performance of my bond portfolio. Interest rates have been low, the credit spreads have been manageable, and therefore my bond portfolios have done well. They've delivered me, circa 10% returns over an average of 4-5 years, which is a fantastic return profile in the kind of markets that we've been in. So, tactical and timing you cannot ignore. I was just talking to some of the students right here. The one course that I did in all my education, I did an undergrad in economics and I went to grad school, business school. The one course that has helped me the most in my career has actually been macroeconomics. Because an understanding of macroeconomic construct of inflation, interest rate, etc. It's extremely important to think about these timings and cycles. Right? So when it might be and what might impact. So that's actually been very helpful to me. All right, number 4. So you do all of this stuff. You got a good portfolio, you made a few bets, you tried to track the timing to a little extent to make sure in the right part of the cycle. But one of the things that I tend to do, which my advice, and again both company and bank, is having done all that, I keep a little bit of thing on the side to bet on the long shots. Right? So the unicorns, the possibility that you can hit a home run. In the bank context, we do that. So we made a couple of small private equity investments. For example, there's a company over here, Torex. They're focusing on trying to create a cure for Alzheimer's disease. And after reviewing it, we looked at it, we said this is a long shot, but if it comes off, it can be a big payoff event. So we put a little bit of money into that company. So it's not big, it's not going to move the needle or destroy the bank, but it's a good long shot to have. The biggest unicorn that we are playing actually these days is this whole transformation to the digital world. We're putting a substantial investment behind trying to rethink our entire business model and rethink the way we do our banking, because we're convinced that what happened to music and what happened to communication will happen to banking. And therefore, we better put some money aside to make sure we're deeply invested in this transition to a digital world. I do the same thing with my personal portfolio. So, well, it's a small amount. I do keep some small amounts of money which I put into private investing portfolios. So as an angel investor, some small sums, 2 or 3 big distributors. I think, so one's in healthcare, one's in alternative energy, small sums of money, but I think if this works out, this will, be a 5 or 10 bagger at a time. And if it doesn't work out, it's something I can afford to lose. So with all of this, it's not a bad thought to think about something that can really give you these home runs a long time. The 5th thing that I look at both for DBS and my portfolio is leverage. So a lot of people will tell you here this thing that debt is bad, don't borrow money. I don't believe that at all. I think leverage or debt is only as bad and as good as you sensibly make use of it. In fact, leverage can be very powerful. Remember, Archimedes once said that you give me a lever long enough and I can move the world. But leverage can exponentially change your outcomes. The problem with leverage is that it can exponentially change your outcomes for the worse. And therefore, you have to be very thoughtful about what leverage you want to use and how can you afford to use leverage sensibly. Now, in our industry, in fact, every company levels. There is no company in the world which operates purely on equity put in by an owner. Every company takes some equity, and then the general rule is, for every $1 you put in equity, you get a couple of dollars in debt. And that allows you to maximize your return on investment. That's a separate factor. Banks and our industry lever a lot more. Because the global community is now talking about a leverage ratio of 3 or 4%. That means banks will lever up 25 times. So every dollar equity they put in, they'll get some 20, 25 in debt. DBS is a lot more conservative. Our leverage ratio is only 7%. I mean, it's 7, so which means that we only lever up about 10, 12 times. But all banks leverage up. So when I joined DBS, one of the things I realized is that DBS is one of its biggest inefficiencies is we were not levered up adequately. We were just not putting money to use efficiently. So we had a lot of deposits, but we're not being able to put them to work in creating loans. So I figured we need to be able to lever up the balance sheet and have a lot more loans in our book for the equity that we had. One of the reasons we've had a good few years is that we've been able to do that quite successfully. But with one caveat, we've always been very thoughtful and sensible about the extent of the leverage we want, because leverage can be a dangerous tool if it is not used well. So leverage is a good tool. It will improve your returns. It will allow you to do well, but you must be very thoughtful about not overextending. That is crucial. In my personal investment, therefore, the rule of thumb I follow is I leverage. By the way, anybody who buys a home, a house, always leverage. Why? You put in a down payment of 20%, you go to the bank for 80%. That's 4 times leverage. Nobody that I know buys a house without leveraging up. So it is appropriate and sensible to lever up your financial investments as well, but conservatively. I never lever up more than 1 to 1 on anything. And the reason I don't is because if things go bad, I don't want to be caught with having to pay margin calls or running into crisis. So my leverage, you could leverage up a lot more and get much better return. My principle of this thing is to be conservative, to use leverage to improve returns up to a point. And then beyond that, make sure it's my money I'm putting to work, not somebody else's money I'm putting to work. All right, so that's number 5. Number 6. And that sort of links, the leverage question linked to that. Finally, you've got to know that you have a reserve. So the last thing you want is to be in a situation where black swan event happens and 3 standard deviation happens and you don't have the reserves, the resiliency or the capacity to be able to go through that. The biggest bankruptcies and the biggest failures happened with people who ran into an unexpected event and then suddenly didn't have the liquidity, didn't have the resources, didn't have the capital at the wrong time. So in whatever you want to do from investing, you must make sure that you have the reserve and the resiliency to take you through a black swan event. In running of DBS, that's the thing I worry about the most. That everything is okay, but what happens in black swan? Am I adequately prepared? Do I have enough liquidity? Do I have enough capital resources? Do I have the capacity to take a tail event risk? And that's pretty much how I think about my personal investing as well. That every time I think about what I'm doing, I'm very disciplined about stop loss. So if I have a view and saying, this is what I want to do, this is not my long-term fundamental portfolio, that I don't worry about. But sometimes the shorter-term piece of this, I have a mental discipline on stop loss. If it comes to that, you better exit because I don't want to take more risk around that. I have a tremendous discipline about, like I said, the leverage I do because I don't want to take more risk than a particular thing because that's all I can afford. So the sense about know yourself is how much am I willing to put to risk, how much would really hurt me, how much would have a consequence of what I can do for my kids and my family, I'm not going to risk that. So the sense of resiliency and having a deep understanding of what is the reserve that you need is number 6. So that's basically the framework I use. Rely on fundamentals, look at mega trends. Within that, make some big bets and make sure you're not just broadly scattered around everything you want to do. Think about tactical timing in terms of the short term when you go in and out. Try and make a few bets for the long term, something that can really move the needle and give you some exponential hits if you can. Use leverage sensibly because it can really make a big difference to returns. And finally, make sure that you have enough resiliency to be able to go through the tail risk and tail events. These are all simple things. You don't have to be a very sophisticated investor. You don't have to know the capital asset pricing model. You don't need to know Modigliani Miller. You don't need to do a whole bunch of stuff to be able to follow this kind of framework. This kind of framework is a pretty common sense framework. But finally, it's all about using judgment and common sense. My advice to you is read a lot. The more informed you are, the more you read and listen a lot. Right? You read and listen a lot, but finally use your judgment. And God gave us our brains to be able to make a judgment and don't always be swayed by what the world thinks and says. That's all the comments I had, and I'm not sure we're going to go sit there and take questions after that. All right, so thank you all. Thank you for your patience.
Thank you so much for your insight. I think many of the questions that are asked by the audience, I don't think it's just for the iPad. They were genuine questions that you probably already touched on or answered. So I will start off with the one which seems to be leading in the race to win the iPad Mini, which is actually co-sponsored by MoneySense and ABS, is something that you touched on, but I want to repeat that question again. So how extensive does one's financial knowledge have to be in order to get at least an average return, taking the average to be, say, the average return over a year of STI for a single year? So just to elaborate that question, it's sufficient to pay attention to news and regularly watch the interim financial reports of the company I invest in, or do I need to have more in-depth financial understanding, which is probably not freely available to the public?
So I guess I talked about that. I really think the large part of investing is you could make a case that if you're a deep financial analyst, you could really understand and figure out the company's position better than a lay person. And the people who do that. If you really want to go into a deep dive this thing, you better know a little bit about ratios and company forecasts and so on. In reality, I don't do that. And I don't do that because A, I don't have the time to actually study a company. And second, I don't invest in individual stocks. But even if I did have and was not conflicted, my investing philosophy is top down. So because my investing philosophy is top-down is based on macro, I start from there. What are the macro trends? And therefore what's going to drive sectors, what's going to drive economies, what's going to drive countries. I tend to focus less on the individual prospects of individual companies. Once I've got a strong sector view and I've got a strong thing, then my general view is a strong sector will carry a few companies in the sector. You don't necessarily have to choose the best if turns out you're the second best or the third best. It's not the end of the world. And as a consequence to me, this thing of looking for alpha based on single stock is not necessary. Right? You don't need to be broadly diversified, like I said. If you wanted to, really get an average return of all the markets in the world, it's very easy. You just buy a stock index of all the markets in the world. So I would recommend that. But I don't think you really need to be a deep scientific understanding of financials and financial ratio indicators. Use judgment, and your judgment is based on what you see happening around you in everyday life. You can make good decisions.
Okay. Now, something which is related to that is that, there are financial constraints that individuals also have. So if you don't have the financial capacity, what would you invest in? Would you actually take bets like what you suggested, or diversify, which Warren Buffett has said as he said as well?
Yeah, so I think one of the things I should have said when the caveat of maybe I'm not a good speaker for this, because the title said affordable investment something. And the reality is that I stopped worrying about affordable a long time ago. I'm not just that's the truth. So, but honestly, see at the bottom extreme, even putting money in a bank is an investment form. Right? So when you put money in a bank, the bank takes your money and invests it somewhere. Right? And so it's an intermediate investment. Right? And so you could always do that. By and large, because when the bank makes an investment, it's a risky investment because at small deposits up to some amount are deposit protected, so your money can't go wrong. And because you're taking such low risk, your returns tend to reflect the very low risk you take. We want to go beyond that doing this thing. I think if you have small amounts of money, it is hard to make these meaningful bets. So I would then still look for getting fund position, but I would still look for a fund which reflected a fundamental view on what I want. So there's no point getting a general fund. So I would take a fund which reflected a view either on a country or on a sector or on a part of the world. And I said if I thought agriculture should be doing well, then I would go along and buy a fund which is agricultural assets. If I thought China is going to do well, I would go and buy a fund and a 2822, an index or a fund which would reflect the fact that I think China is going to do well. So I would still use my fundamental, but I would buy a fund and put some money in that because that allows you to do one investment without trying to buy a lot of $100 things.
Very good. Now, this is kind of related, I think, very Singaporean question. Now, we saw the high inflation environment at some points. Now it's pretty low. So, would you advise buying into property more than assets like stocks and bonds?
I think property is an unusual asset class. First of all, I think property is a good asset class for everybody to have because of owner occupancy issues. So in the first instance, I don't even think of it as an investment. I think of it as a protection against future rentals and inflation. And therefore, if you don't have a property, then buy one because in the long term, it will protect you from the consequences of potential asset price inflation. That's probably a good thing. But let's assume you're thinking about it as an investment thing. The truth is, if you look at most of the money made in Asia, across the board, whether it's Li Ka-shing, whether it's the Solanki, whether it is Philippung, whether it is Robert Fox, look at the bulk of Asian wealth in the last 50 years has been in the back of property. Single biggest source of wealth. The only change will be now with Jack Ma and Alibaba and some tech, WeChat and Tencent and so on. But historically, property has been a big source of wealth in Asia. The truth is that when you have large growing demographics and you have the trends I described, increasing urbanization, increasing middle class, increasing growth, and you have a finite supply source of commodity, which is land, then the supply-demand thing will play a role in the medium long term. So I think fundamentally you'll find that in all economies which are in growth stages, you will see asset price inflation in property. And the property is not a bad asset to have. The second reason property is a good asset to have is that you can safely lever up property. So the reason people do well with property is that, where I said, I think it's inadvisable to lever up more than 1-to-1 in financial assets. In property, you can get 70% with 30% equity, 75% with, so you can lever up 3 or 4 times, and leverage improves the returns. The reason you can leverage up is because you have a very solid collateral. The house is good collateral, right? So it's not like something else you can disappear. So because property allows you to lever up more, and because by and large in growing economies like Asia, you will see asset price inflation, property is actually not a bad investment to make. The big downside of property as an investment is liquidity. And so this goes back to what I said. If you have the liquidity and the capacity to stay with it, not a bad. The problem with property is that if you really think I suddenly need the money, and you happen to be going through a down cycle in property, Singapore has been slow the last couple of years, other markets, getting out of that investment is very difficult. And the haircuts you have to take when you get out of the chunky investment can be quite severe. So property, if you bring it for owner occupation, go with it because you're going to live in the house, you hopefully don't have to sell it. Property as an investment is probably good, but make sure you have the liquidity and the capacity to stick with it. If you can stick with it and don't have to sell at the wrong time, you'll probably make a very good return.
Very good. That is very, very informative. So a question from, mostly from the students of portfolio management that I teach. The question about active versus passive investment. I mean, you touched on it in your speech as well. So, I mean, you mentioned about asset allocation in sectors. So, what is your feeling about going into ETFs, which are exchange traded funds, as opposed to actively choosing the stocks, the bets, the big shots that you talked about?
So, my view is that when you choose ETFs, depending on the ETF that you choose, you're actually an active investor. Right? So, you're not active within the country. But the fact that you chose a China ETF versus an India ETF, you made a selective choice based on merit. So to me, as long as you choose an ETF because you've whittled down, saying I want to be in the US or I want to be in China, that's already an important case of active investment. Now within the country, you have a choice of saying, do I want to get sector specific, or do I want to go to stock level, or I'm happy to write this country's thing. Part of that depends on how much money you have, part of that depends on how much time you have. And part of it then starts depending on how much skills you have. If you have a reasonable amount of money and time, I would say try to look for the alpha. It's not a bad thing. If you don't have the capacity, either money, so resources are somewhat limited, like this thing, or you don't have the time, and you have a view on the country. I'm happy with China's growth. If I can get the average of China's growth in the next 5 years, I'll be quite happy with it. Then, be passive in that context. A general passive thing that I'm going to put my money into a diversified emerging market fund because I think all emerging markets will do well. I tend to be wary of because I just think that, like I said, that's kind of lazy investing.
Right. Very good. Now something else which is kind of what you touched on financial technology as well. So there has been a lot of emergence of these robo-advisors. So what is your view on young investors following essentially automated data analytics solutions for investment?
I think there's potentially, these can be game changers. And I tell you potentially, some of you might know, we tied up with IBM on an artificial intelligence machine called Watson. I'm not sure how many of you are familiar with Watson. But Watson basically, IBM first invented 10 years ago a supercomputer called Deep Blue, Big Blue, which they trained to become the world chess champion. Then 3-4 years ago they invented Watson and they taught it to play Jeopardy first. Right? So Jeopardy is a TV quiz show, it's a British and US show. And the thing with Jeopardy is it's not a normal quiz show. They ask you, you've got to answer it in reverse. They put answers, then you've got to ask the question. And so that meant the computer must not only know everything, but must be able to understand language, understand the nuance of the question to be able to respond. And they did that to demonstrate the computer's artificial intelligence today is so good it can actually understand language. Then they took, Watson won Jeopardy, became the world Jeopardy champion. And they put Watson to work in a couple of areas. One was in healthcare oncology. So they taught Watson, Stone-Kettering oncologists taught Watson on how to diagnose cancer. Today, Watson can diagnose cancer better than 99% of doctors in the world. Right? Because Watson now has read everything about cancer, knows all the latest stuff on cancer, knows all the treatments. So when you go and talk to Watson, he'll ask you, do you have a headache here, does your back twitch, and so on. And say, boom, you have cancer, you don't have cancer. The other area where they wanted to use Watson was for wealth management. So your question, I think about how we do wealth management. I told you my personal investing philosophy. The reality is that that's how private banks and wealth managers operate. We wake up in the morning, and Sebun, who's going to talk to you later, he's got a bunch of analysts and researchers, and they will come and give him some 5 or 6 big ideas in the morning. This, go long US, sell China, buy copper, some big theme. Guys, you got to focus on a few fundamental things. As a human being and as a team of analysts, you can't focus on much more than that. We get some big ideas. And Sebun's a very smart guy, but he gets a few big ideas. Then, so at 8 o'clock, he has a conference call with all of our 600 bankers in all our countries, and he tells them the few big ideas. All of our bankers then call all of our wealth clients, 300,000 of them. So either they call or the wealth client calls or we have interaction. And by and large, we give them some variant of those 6 big ideas. A good banker who's smart will make sure I'm not going to call these 5 people because I know they're not interested in this. So we'll only focus on the people we know might be interested in these ideas. A bad banker, if we have some, will just spout the same idea to everybody. Now you think about this thing, right? So and that's basically the essence of it. Now what does Watson do? Watson, first of all, can read 1200 pieces. Actually, they can read a lot more. We feed it 1200 pieces of research. So Watson doesn't have 5 big ideas. Watson can have 100 big ideas. Watson knows every asset class, everything that moves. So because it's artificial in the range of asset classes, variables, price moves, much more than the human brain. Second, what Watson does is read every one of those 300,000 client portfolios I have every day. It reads the portfolio, it knows what you like, what you don't like, what your risk tolerance is, what your risk profile is, what you bought in the past, what you hold, and what price you hold. And then it does a match. So you think about the capacity to match all the asset ideas with your individual profile. The 3 recommendations that comes up with are customized to an individual. That based on your profile, your risk tolerance, what you've done, these 3 things are more suitable to you. So that's the theory of the case. Now we spent the last 2 years working with Watson to train it to think about all these things. The reality is we're getting about 85 to 90% success right now, which is not bad. So I'm getting much better success than a typical RM. But at the same time, Watson's ability to understand everything is not as well defined as you would expect. So, sometimes Watson doesn't interpret things 100%. So we haven't used Watson yet and given it to our customers to use. We use Watson to advise our relationship managers. So they use it, look at the recommendation, whether they can use their own judgment on top of that. But even the progress we've seen in the last 2 years has been quite dramatic. So in my own view, where the world is going, there is a real material role for robo-advisors because the capacity of a computer to read, understand, profile and match will be much better than that of a human being. In the short and medium term, I think they will only be complementary and therefore you can still benefit from somebody who is a physical advisor using that information sensibly and making the right judgment calls for people. But I would bet on that 5-10 years from now.
So maybe advisors might not have a job. Now, I think we have quite a few other questions. Maybe we should give 1 or 2 questions quickly from the floor. Please identify yourself, and I think if there are microphones out there, any questions that you have from the floor? Remember there are participation points in SMU classes, so. But I think most of them got all their questions answered. One question which came out as well, which is, you talked about reading. So, can you suggest 2 books that everyone should read?
I read Benjamin Graham. That is the Bible. Go read Benjamin Graham. It is the single best thing you can do in your life. Go read Benjamin Graham.
All right. Thank you so much.
All right.